Morning, everyone. We'll just wait until everyone's into the session and then we will commence. Okay, I think that's what we'll do is we'll make a start. Everyone's come through from the waiting room. Welcome to a retirement planning webinar. My name's Paul Lynch and I'm the Regional Manager for the Brisbane office. Today, we're going to go through what we consider is important information in terms of retirement planning. The one thing that I would say is, unfortunately, we are unable to do these live today. We had planned to do these in a suburb of Brisbane live. I'm very disappointed that we're all in lockdown, or many of us are in lockdown. So unfortunately, we moved to webinars only just this week. So today we're pleased to be able to bring to you, but unfortunately, we would have preferred to see you face to face. Today's session, we have Tom Rouse, our financial planner from the Brisbane office, to present with me in terms of financial planning. So welcome, Tom.
Morning, everybody.
I would like to highlight that Tom had actually been preparing for months for this seminar with a song and dance routine at the break for morning tea, and I was going to bake. So unfortunately, just being a webinar, we'll just have to stick to keeping it simple and stick to the script. I suppose before we start, I would like to conduct a welcome to country. I would like to acknowledge the traditional custodians on the land on which I work and live. I recognise their continuing connection to land, water and community. I repay respects to elders past, present and emerging. I'm not too sure whether you've all been to a financial services company's presentation or seminar these days, but we have to stick to some legal sign-off requirements before we start. Today, we've got a disclaimer, and I always make the comment that if you can read all of that information, then maybe you're potentially not ready for retirement. This disclaimer, it just outlines what we can and can't provide. Today's session, Tom is joining us and we're going to be conducting this webinar in the context that it's just factual information. We cannot provide financial planning advice in these sessions. So today we will be welcoming questions and I'll go through that in a moment. But we must answer these on a factual information basis. So I'd just like to remind you all of that. If you do want further information on the fund, I would recommend that you go to the website of www.catholicsuper.com.au. And I would also recommend that you read the terms and conditions outlined in our product disclosure statement. We also have there our financial services guide. That there probably gets the risk and compliance people off my case and saying that I've given you that warning. So today we'll move on in terms of a bit of housekeeping. Tom and I, we do have slides prepared for today. If you do want to ask a question, what we'll do is that we will do, if you want to use the chat or the Q&A section on this Zoom call, I will be looking at those gradually during the presentation, and then at a point during the session, I will come and answer some of those, and then we'll come back to more at the end. So if you do have any questions, please do not hesitate to use the chat or the question and answer session. In terms of today's session, some of you are members of the Australian Catholic Super and Retirement Fund. You may have heard of the exciting news that we're planning to merge with the NGS Super, or non-government school super. This is an exciting opportunity for our fund where two like-minded industry funds are coming together that very much represent education and Catholic care services and many other Catholic Church organisations. We're coming together to provide a very values-based superannuation going forward with approximately 200 odd thousand members. I was going to say we've got 90 odd thousand members, but about an organisation with about 200,000 members and about $23 billion under management. So we're going through the due diligence process. We're looking at basically the best of both worlds within the superannuation industry, looking what we offer, what they offer, And we will be coming forward as a merged entity with the best of breed. So it really is an exciting opportunity for the members of both funds to come together, have a very focused superannuation fund that certainly will provide the same level of service that you would all expect. The one thing that I would say, if you do want further information, we'll be communicating with you at times. I would recommend you go to that website of the www.catholicsuper.com.au/merger. We will be releasing information there from time to time as the merger negotiations progress. Now, to get in terms of and prepare ourselves for retirement planning, I suppose when Tom and I do these sessions, we always start with the very big question of, well, what do you think you need to have in retirement financially? It always comes down to that ugly B word. And Tom, I would imagine during many of the financial planning appointments that you've had, that when you mention the budget word, people may screw their nose up. I certainly know that I would. But you would need to have a look at your plans for retirement. What you're actually going to do will predict how much money you may need. I note there that there's the word cruise on this slide. I don't see, given the fact that many of us are in lockdown, I don't think there will be many doing that. I would just actually like to travel outside. But certainly travel is on a lot of people's radar for when it comes to retirement planning. If you're doing things like that, that may require a large amount of cash to fund that. So it comes down to the point of, well, how much will you need will depend on the lifestyle that you have in retirement. I know many family friends have retired, but utilising their time to volunteer, to look after grandchildren and the like. Well, that is a different set of expenditure. In a moment, we're going to go through what people would or what people are currently living off in retirement. But Tom, probably the question I have for you is that how do you go about, I suppose, how do you start consider that you're working? How does life differ in retirement in terms of your budget and what should you consider?
Yeah, very good question, Paul. I mean, whenever I see clients, it's all about goals. So planning for retirement is all about these goals. So really it's taking the time to sit down, think about really what you want from retirement. And as you say, everybody's got a different view, from family to travel to camping. So, and what you mentioned there previously, the B word, is probably the most important thing when you're planning for these goals: budget. So it's probably the most difficult thing to do, because everybody has an idea of what they might be able to spend. But as you said, we're going to talk about it. The best way that I find that you have to look at the budget is, well, what sort of lifestyle are you having at the moment? So while you're working, what sort of lifestyle are you wanting to achieve, and do you want to maintain that in retirement? Is that the goal, that you want to maintain your current lifestyle? So you've really got to be thinking about what you're spending just before retirement, going into retirement.
For sure. Thanks, Tom. The one thing that I always tell people is that there is actually a study that is being conducted every quarter in terms of what people are spending in retirement. Now, down below, I always tell people that if you want the details of this study, it's called the ASPA Retirement Standard. Now, you can download quite a detailed document that basically goes through on what people are spending in every different capital city in Australia, or otherwise there is an abridged version. So the one thing that this study does look at is that it surveys people, singles and couples, of what they're currently spending in retirement. Essentially, for a single person, a modest lifestyle is $28,179, and for a couple is around about $40,000. So that's the middle box there. The one thing that I would like to draw your attention to, going to the left on the slide, is what the full age pension is paid at. Now, if you meet the eligibility criteria, and Tom's going to go through that later, if you meet the eligibility criteria on the age pension, the full pension payments for a single is around about nearly $25,000, and a little bit over $37,000 for a couple. Now, today we need to have a look at saving as much as we can for retirement savings. Now, often we hear about this talk of people needing $1 million in retirement. And I just wanted to allay people's fears, or actually dispel the myth that sometimes that is actually not correct. I always use the simple mathematics, or the expression is that if, for example, we retire at 67 and we go through life and live for 30 years in retirement, and you really want to live on that modest lifestyle, there's around about $4,000 difference in retirement there. Let's round about $4,000 difference between the full age pension and that of a modest lifestyle. Now, if you're living for 30 years and the fund doesn't earn any interest for that period of time, you're just needing an amount of $120,000 in savings to fund to get to that level. So really, today is not talking about setting the goals really high. It might mean that it's just talking to you about that, putting into effect some very simple items. It may mean that you're looking at maybe 10 or 20 grand more in your retirement savings. Those little tweaks mean that it could mean that there's an additional few years of retirement savings there. Now, the one thing that it does do is that it provides people on a comfortable lifestyle. So, Tom, I've got the figures there, about $62,500 for a couple. Can you go through, Tom, and provide us an update on, well, the differences between comfortable and modest and what they look like? And also, what sort of capital would be needed to fund the comfortable lifestyle?
Yes, Paul. So with regards to that more comfortable lifestyle, which is, look, most people do want a more comfortable lifestyle in retirement. Everybody's different. So this is where you need to think about, well, what's comfortable for you? Okay. So taking that as for standard, which is about $63,000 for a couple, 44 for a single, you can see that you are going to need savings to top up any potential age pension that you're entitled to. Okay. Now, you had the question there that you need $1 million to be able to get that comfortable retirement. Well, depends upon when you retire, so that is a key factor, and how long you want the money to last. But if you do retire at 65 and you want your money to last till 90, as a couple, you would need combined savings of about 650,000 to be able to top up the age pension over your retirement and have that more comfortable lifestyle in retirement as a couple. And then as a single person, you probably need more around the $550,000 mark to be able to top it up to that comfortable lifestyle. Now, the caveat with that comfortable lifestyle is to remember that you do own your own home and you're debt free. So that's pure lifestyle, I guess, needs, income that you want. But this is where, again, through planning, we look at, okay, well, what are the levers behind making sure that whatever money we do have to fund our lifestyle, we're using in the best way and making sure that it lasts as long as possible. Often it's that couples and singles want more capital or more income, in the initial years of retirement because they're doing more active things. And then when they do get to their 80s, maybe a more modest lifestyle is all they need to fund. So again, everything's very different for different people. And this is why, I guess, looking at your situation, planning for it, okay, are we in that stage where we can look to that comfortable lifestyle? That's what we always plan for.
Yeah, lovely. And I would imagine, Tom, that the great amount of Australians would actually be eligible for some form of age pension to supplement their income.
Oh, that's definitely correct. I mean, the studies show that people retiring today, about 70% of the population retiring today will rely on the age pension in some form throughout their retirement. So the age pension for the vast majority of Australians retiring will form part of their retirement planning. That number will drop over time as super savings grow and people who have been working longer in the system and had more super, because it's just gone up to 10% as well, going up to 12, that will gradually over the next 20 years be reduced, which is what the government is aiming for, to have less dependency on the age pension over time.
Thanks, Tom. What I would say is that there are some differences between listing in the reports from the ASFA standard. So if you were to actually just Google ASFA retirement standard, it should come up as the first key in the Google search. There's the listings there of the differences between comfortable, modest and age pension. I always have a little bit of a joke in terms of some of the items of how they differentiate there. But certainly I would recommend that you have a look at those. The one thing that I just want to remind people is that if you do have any questions, we've got one already through the Q&A facility or the chat facility, you're more than welcome to send those through. So Tom, when we look at retirement planning and the like, and you've sat down with someone in terms of, okay, they're sitting on maybe not a comfortable level, but in income in retirement, what factors do you go through to determine, well, where do they fund their retirement from?
Yes, so whenever we see a client, Paul, I guess we don't just focus on super. So yes, we work for a super fund, and super is very important, but we take what we call a holistic view. So we look at everything possible to help fund your retirement. So that might be cash in the bank that you've got, shares that you've accumulated over your life, either through inheritances, buying them yourself, or getting them given to you. A lot of clients have had shares actually given to them if they were part of a company that became private, and any property as well, whether that be an investment property or the family house. So we look at your whole situation and then take that into account with regards to going back to, okay, what are your goals? What do you want to achieve? And then how do we do that in the best way using this holistic view of your financial situation? I guess a personal example, and I always bring this up, and Paul knows this, is always about my mother-in-law.
I was going to say, Tom, I think we're up to slide 8 and you have not mentioned the mother-in-law yet. I'm sitting here going, my goodness, what's going on with Tom today?
Must be a record.
Predictable.
No, the reason why I bring her up is because she's a typical client that I see, female. She's widowed, so she's on her own, and she was planning for retirement for the past 10 years, and luckily enough she had a son-in-law that was willing to help her, which was all good. But with her situation, because she didn't have a lot of super, that really it was, okay, what do you want to achieve from life? And for her it was that travel that you mentioned earlier, Paul. That was one of her really big goals, that she hadn't really traveled a lot, so she wanted to travel. She's done a bit of that already, but obviously the last 18 months hasn't been able to do that. But what we ended up with a plan for her was how we used the family home to help fund that. So it's not for everybody, because often the family home people want to hold on to for as long as possible, either pass it on to the kids or they don't want to move. So, but for her, it made perfect sense. Well, if she downsized, used the surplus cash from the family home to top up her super, then she's got the liquid assets to do what she wants in retirement. So this is what I'm talking about when we're planning. We look at a lot of different scenarios and really all your financial circumstances to go, okay, how do we meet what you want to achieve in the best way?
Thanks, Tom. I suppose later in the session we'll be going through about getting money into super and how you can do that with contributions, downsizing and the like. So we'll be going through that in a moment. I suppose the big question is that why would you invest in super? I know that I've sat through many of these sessions where Tom always talks about that, well, you can go through and invest in shares and property and cash and the like, but superannuation is only just the vehicle that it sits in. Now, the vehicle that it sits in is a very conservatively taxed environment. Now, I always say to people that if you hold assets outside of super, they earn, or you get a dividend, interest and the like, that all gets added to your taxable income and taxed to your marginal rates. And we're going to be discussing those in a moment. But if the money whilst you're working is accumulating in superannuation, the investment earnings are taxed up to 15% in super, and the same rate if you're sitting in a transition to retirement pension. There is another colleague that I've worked with that has always expressed the point of view that by having money invested in super means that you can move it to an account-based pension, which he refers to as a tax nirvana, a tax-free product that you can utilise for your retirement savings. So not only tax-free in terms of the investment earnings, but tax-free from your personal income side of things on what you can draw out. And it has the flexibility of doing lump sum withdrawals as well, providing your age over 60. So certainly the benefits of accumulating money in a superannuation fund are key, in the sense that by housing it within super, there is the potential to get tax concession treatment during the superannuation or accumulation phase, but pushing it to retirement into a tax-free product. So I would imagine, Tom, most of the people that you would see would utilise these tax-free products simply and purely to house their, or use that vehicle to house their retirement savings.
Oh, exactly. And look, this is why the government introduced super and gave it this tax-free and tax concessional treatment, is really to incentivise people to save for their retirement. So whenever I see a client for the first time and they're a bit maybe wary of super as an investment, well, you've got to remember, as you said, super is not an investment. All it is a tax vehicle for investing. You choose the investments once the money's in super, okay? So that's the biggest thing to remember. Yes, there's a catch with super. The catch is always access. When can I get the money? So that's why when you're 20, 30, well, you don't really think about super because you can't touch it for 40 years. But as you're approaching your 50s and your 60s, well, that time frame of when you can get the money is a lot shorter. And you've got all the upside of having those tax concessional treatments of contributions going in, interest you earn on the money. So that's all it is to remember. All it is a tax vehicle. And that's why it's the best tax vehicle for retirement. And it's why the government put limits on what we can get in there. They wouldn't be giving us these great tax concessions if for everything. Otherwise, millionaires would be putting all their money in super. So that's why they put these limits on how much you can get in. And we'll talk about that later.
Lovely, thanks, Tom. I suppose the one thing that when you mentioned there that asked the question of when you can get your hands on the money, if I had $1 for every time I was asked that when I've been performing workplace visits, I probably today would have been retired already. In terms of having access to your account within superannuation and then utilising it to fund your retirement, you need to meet what they call a condition of release. Now, currently for people aged 58, 59, now I will note that this age group is narrowing and it's a transitional group. And eventually we'll get to the phase that area will cease, and anyone born after July 1964 will fall into the category of having access to their account from age 60. The one thing that I would mention is that those aged currently 58, 59, if you retire, sign a statutory declaration that you've genuinely retired from the workforce, you have access to your superannuation. Now, it's becoming very uncommon. I suppose when I first started working in super, a lot of people were retiring at 55. New trends show that there's many people still working post the age of 65 in some form of capacity. So it's a very rare item. But to have access to your account at that age, you need to genuinely retire from the workforce at 58, 59. Once you turn 60, the rules just change ever so slightly. You've just got to cease an employment arrangement. So you don't need to prove that you've genuinely retired from the workforce. You just need to cease an employment arrangement. So it may be that you've resigned from full-time employment and you become a casual. Providing that there is a break of service, you have access to your account and you can then commence what we call an allocated pension or an account-based pension, or take a lump sum withdrawal. The next phase of access is anyone who turns age 65. So the wonderful thing here is that once you turn 65, you have access to your account, working or not. So it means that you're able to do a withdrawal. You may want to use that to pay off debt, or it might mean that you can start an allocated pension plan to use whilst you're still working. So Tom, can you just run us through some general trends that you're seeing with people working? I do know that most people these days are retiring later in life. There's quite obviously a strategic opportunity nowadays with rules changing and ability to make lump sum contributions. I would imagine that this has really changed the focus of what you look at with clients these days.
Yeah, definitely, Paul. I mean, you mentioned earlier there 58, 59. It would be very rare now that I see clients before the age of 60 trying to access their super, and purely because it does have some potential tax consequences if you do access super before the age of 60. So that's why a lot of people in that bracket probably, well, they say, I'll hold off till 60, I'll hold off that 2 years, because 60 is the golden age. I mean, there are benefits to turning 60. That is when that any money you take from super is tax-free. You don't have to put it in a tax return. Do be aware, though, that if you access super, it may have potential Centrelink consequences if Centrelink are involved in your life. So that's just the caveat with regards to accessing super after the age of 60. But yes, 60 is the golden age where definitely people need to be planning, okay, what are we doing with our super? Because the options that are available to members and clients and the public with regards to their super is it can be endless with what they can do. So you mentioned there already, do you pay down debt if you've got that? Can you build up your super in a better, more tax effective way? And we're going to talk about salary sacrificing. So this is where definitely from the age of 60, there's key planning issues that you need to look at. And 65 as well is a very key age, because as you've said, even if you are working full time, you've got full access to your super. It's like a bank account. So there are strategies that we look at. Okay, what do we do at 65? And that might be more around what we call estate planning strategies. So, and we'll talk about that later on as well. So just have these key ages in your mind that, okay, really you should be looking at getting advice around, okay, what are we doing at these key stages?
Thanks, Tom. Now, we mentioned to you before that, PAYG tax. So I thought I'd go through and take you through, well, what is salary sacrifice? Now, given the fact that it's the 2nd of July, we're 2 days into very new tax thresholds. The government has tweaked slightly a year or so ago the tax thresholds, and it means that there was a modest tax cut for lower income Australians, whereby that they're paying less PAYG, so, or pay as you go. Now you can see there on the slides, these are the marginal tax rates that you pay on your income. Now, before we start talking about salary sacrifice, bearing in mind when we talked about investing within superannuation, we mentioned that the investment earnings are taxed at 15%. If you have investment earnings and you're working still, you can see there that if you hold those assets outside of super, that investment earnings is going to get taxed at an extremely higher rate, because it's going to get added to your income here and taxed at those marginal rates. So commonly, many people are being taxed in the bracket of 32.5%. So having investments within that superannuation vehicle is very tax efficient. Now, in terms of salary sacrificing, I always tell people that it's the opportunity to boost your superannuation with a little bit of tax assistance, but it doesn't work for everyone. I would tell people that your foregoing income, or your employer is reducing your salary and pushing that towards your superannuation account. Now, when that contribution comes to a superannuation fund, it gets taxed at a flat rate of 15% when it goes into your superannuation fund. So you can see there that for anyone earning $18,201 or more, if they were to have that money in their hand, they're going to be paying tax at a higher rate. So there are many people that can benefit from salary sacrificing. And the more you earn, the more you pay in tax, which could mean potentially that there is a greater tax saving for you if you were to forego that income and push it through to your superannuation fund. The only caveat that I would probably put on it is that there are things called the government co-contribution and the like. Now, it may mean that salary sacrifice doesn't work for everyone, and you can put in what we call a post-tax contribution. So I'll mention those in a moment. These could become eligible for what we call the government co-contribution, which may mean that you actually get more tax benefits or overall benefits from the government by putting in post-tax. And if you can't afford to do both, then maybe it might be just the case of doing a post-tax contribution. So salary sacrificing is beneficial. And I would imagine, Tom, that the majority of people that you look to a strategy of boosting their super by way of this form. Would that be correct?
Yeah, definitely, Paul. This is the number one, I guess, focus because you've got to remember, this is a guaranteed return on your money in terms of the tax saving. Okay. Again, the catch is, well, any money that you put into your super, obviously it's not in your hand, in your bank account. And then you've got to remember when you can access your super. Okay. So any money that you do put into your super to get these tax savings is locked away until you meet that condition of release that we talked about earlier. But this is, again, a guarantee that you save on this amount of tax by putting it into your super, and then the money gets invested. So not only have you got more money invested in an investment, but the interest you earn on that money is only taxed at 15%. So again, it's going back to what is super. All it is a tax vehicle for saving for retirement. Okay. So yes, any money you put into super does reduce your take-home pay. And we need money to live and do things and pay down debt and help kids or whatever we need to do in life. So this is where, especially if you're 60 and you're still working, that how we use the super system can be very important, because as we've talked about earlier, when you turn 60 and you can access super tax-free, there's something called transition to retirement, where even if you are working, you can access super tax-free. There's just a limit on how much you can get from your super. But if you think that, well, that can be a tax-free source of income, and then you put money into super to save on income tax, you can use the system to maintain your overall level of income, so you can still do everything you want in life, but reduce your overall tax liability and effectively have more super savings between the ages of 60 and when you eventually do want to retire. So again, going back to 60 is a key age that you need to look at, okay, what are we doing with our super to plan to make sure that we put ourselves in the best position.
I suppose, Tom, that it all sounds wonderful, but unfortunately the government's put on a little bit of a limit. Now, salary sacrifice contributions come to a superannuation fund, and we call them concessional contributions. Now, concessional contributions include your employer support, any additional employer support that they may provide. It may mean that it's the deductible contribution. Now, from 1 July this year, I would note, I would say to people is that the compulsory rate of super is going to 10%. So it may mean that there could be more employer superannuation support in your account. It may mean that you might not be able to salary sacrifice as much. And from 1 July, we've actually had an increase in the amount of concessional contributions the super fund can receive. It's now $27,500. So if your employer is putting in $10,000 of employer support, then obviously you are left with salary sacrificing $17,500 to get you right up to that limit. So, Tom, I suppose that we're talking about concessional contributions, but it's just not as simple as that. Like, we could have people that may be able to use some unused contributions and the like, or some other strategies to do even more than this 27.5.
Yes, that's right, Paul. So a couple of years ago, the government changed the rules around what we call a carry forward provision on any unused concessional contribution cap. So what that means is if somebody has a balance of less than $500,000 in their super, so that's the first criteria, that any unused cap from the 18-19 financial year onwards, so let me just get this right. I think there's 4 years now. So it's 18-19, 19-20, 20-21, and now we're just into the 21-22 financial year. So the previous 3 financial years, if you haven't used that full $25,000 concessional cap, your super balance is under $500,000. then there is the potential to actually carry forward that unused cap from those 3 years and add it to that $27,500 that you've got for this financial year. So that they brought this in to say, okay, well, if people don't want to put money into super because they're doing other things, paying down debt, paying school fees, etc., and then suddenly, well, the debt's gone, school fees are gone, now they've got surplus cash, that they can use this system to catch up with those unused concessional caps from those previous years. Now, effectively, after 5 years, you won't be able to carry more than 5 years forward. So in a couple of years, it will only go back 5 years. The best way to check if you've got any unused cap is if you've got a MyGov account and you go to the ATO website. There's actually a super section that actually shows you, okay, how much unused concessional cap do you have? So it's actually really, really good system to just double check, okay, do you have any unused cap? And also it tells you what your total super balance was on the 1st of July. So just to mention that $500,000 is, you have to have $500,000 or less on the 1st of July in the financial year that you want to put in these extra contributions. As soon as you go over the $500,000, well, then you can't use that carry forward provision, okay? But if you go over the $500,000, it gets a bit complicated, Paul, because if you go over the $500,000 during the financial year, that doesn't matter. It's only what the balance was on the 1st of July is what the tax office care about. So all I would say is, because it is complex, definitely get some advice if you are going to look at using that carry forward provision.
Yeah, lovely. Thanks, Tom. We've got a couple of questions. So what we'll do is that we'll just go for a couple more slides and I'll come back to those questions there. So we've talked about concessional contributions where you're getting a possible tax benefit for it, for contributing in, getting taxed at salary sacrifice at just 15% on entry. There are what we call non-concessional contributions, and really at the last minute, at the end of the financial year, we had an update in the legislation, and these have been somewhat tweaked as well. So non-concessional contributions is basically if you've got money sitting in a bank account that you want to put into your superannuation account. So it's not through salary. It might be though a post-tax deduction from your salary. So it could be just a deduction from your salary that you have just as a normal deduction through that payroll process. They are what we call non-concessional contributions. So you've paid tax on every single one of these dollars. They come to the fund totally tax-free. Okay, there's no taxation upon entry to the fund. Simply and purely, at some stage, these funds would have had tax paid on it, and therefore it comes into a total of tax-free. So those under 67, you can contribute $110,000 and you can bring forward 2 other years and make a contribution in one financial year of $330, providing that you don't contribute anymore for the next 2 financial years. So certainly there is an opportunity for individuals to make a contribution. Now, the slight tweak was that previously people under the age of or over 65 and under 67 couldn't use the bring forward rule. But there was also a group of people that had to meet a work test. Well, that has actually all now gone by the way. And now the only people that need to meet a work test to contribute just $110,000 a year are those people aged between 67 and 74. So if you're still working and working gainfully employed for 40 hours over a 30 consecutive day period, I sometimes, Tom, have to take a deep breath before I say that, because sometimes I get it around the wrong way. But a nod and a smile would confirm that I think I've got it right today.
Yes.
Yes, thank you. So 40 hours over a 30 consecutive day period is when you've met the work test, and you only need to meet it once during that financial year to be eligible to make that $110,000 contribution. Now, the one thing that the government has done is that once you turn 75, the door closes to the amount that you can push into your superannuation fund. The door may actually close when you turn 67 because you're no longer working. So that's where I suppose strategically, Tom would come in and look at your situation and say, well, let's look at the timing of if you're going to sell down property, or heavens forbid you won lotto, then we look at the timing of when you can put the maximum amount into superannuation. So Tom, I would imagine that that would take some planning for some people of what they look at in terms of investment properties and the like.
Oh, yeah, definitely, Paul. If there's other assets, again, going back to all super is a tax vehicle. If there's other assets that you want to get into super, maybe that's share portfolios or, as you say, an investment property, then you have to think about these times 65, 67, 75 to make sure that you're planning, okay, getting this money into super. The good thing, as you've mentioned, is the government have relaxed the rules, I guess, to allow people to put money into super. So that's a really good thing, that now people up to 67 can use that bring forward rule. And you've got to remember, this is each as well, $330,000 each. So if you're a member of a couple, it's actually 660,000 that you could get into super as a member of a couple. And the other good thing is not passed through legislation yet, but I'm pretty sure it will, is that work test for 67 to 74-year-olds is potentially going from the 1st of July next year. So 1st of July 2022, there's a proposal to get rid of the work test altogether. And again, that's going to open up the doors for people to put money into super who previously couldn't. So again, thinking about these key ages, what are we doing? How are we making sure that we fund our retirement in the best way? And the other important factor, as you've already mentioned, Paul, is this money that's been sitting in your bank account, or that's in your bank account that you're putting into super. This goes into what we call the tax-free component. So what that means is that if that money ever got passed on to beneficiaries, and it's mainly adult children, that money would also get passed to them tax-free. Okay. Any interest that's earned on that money, if it's an account-based pension, also is tax-free interest. So again, it goes into the tax-free component. So it can be quite a powerful estate planning tool to pass on, I guess, monies to adult children in a very, very tax-effective way. So again, thinking about what you want to do, whereas assets outside of super, then there's potential capital gains tax issues that you've got to think about with assets eventually passing on to children. So again, this is what we plan, not just for now, but also for the future.
Tom, I suppose I just wanted to address, there's been one question, and whilst we're on the slide, I know I said that we'll do questions in a moment, but there's this one question that I just wouldn't want to clarify, and it's just, Julia has just asked if under 67 you can put in 110 per annum.
Yep.
At 15% tax per year, is that right? And I would probably answer that with not quite, Julia. So would you mind just clarifying that again, Tom?
Okay, I guess with regards to the question, it might be taken in a couple of ways, but
yeah,
if you're thinking that you can reduce your tax liability up to 110,000, then you can't claim a tax deduction on these non-concessional contributions. Okay, so because you don't claim a tax deduction, then there's no additional tax going into super. So of a non-concessional, if you put $110,000 in, $110,000 goes in, and there's no 15% tax that's deducted from it, like a concessional contribution. Okay, but you can't claim any tax deduction on that contribution that you've put in to reduce any other income tax liability that you might have. You can only claim that on the $27,500. That's the limit for those concessional contributions. So again, we're talking about two separate limits. We've got the $27,500 concessional limit that you can get tax concessions for. So that's either regular salary sacrifice, tax deductible contributions that you put into your super. And you've got to remember that any employer contributions add to that $27,500 limit. So those are taxed at 15%, and then you don't pay your marginal tax rate on those contributions. This $110,000 that we're putting in, this is what we call an after-tax contribution. So you've you've paid whatever tax you've had to pay on it, your income tax, capital gains, whatever you've had to pay, it's already in your bank account. And then when that goes into super, well, there's no additional tax deducted from it. There's no 15% because you've paid your tax already on that money because it's already in your bank account. I hope that makes sense. And
I was going to say is that what we can do is we can arrange to get a regional manager to give that person a call, or Julia a call, or I can do it. But we can certainly arrange just to make sure that we get that information provided.
Yes.
I forgot to actually hit the button to show the next slide. So we've talked about the concessional contributions and the non-concessional contributions. Tom, would you mind just quickly going through on how else we can get money into your superannuation fund?
Yep. So there are a couple of other ways to make sure that you're, I guess, making things simple and getting money into super. So spouse contribution is a good one. Now, spouse contribution actually counts towards that non-concessional limit of 110,000. Okay. But what a spouse contribution is if somebody puts in up to $3,000 as a spouse contribution into their spouse's account, and their spouse is on a low income. Now, what the government classifies as a low income is less than $40,000. Then the spouse putting that money into the super fund on behalf of their spouse, that they can claim a tax offset of up to $540 off their tax return. So this works really well when you might have one spouse earning more income than another, or one stay-at-home spouse and another working, that adding money to that spouse's super for the low income spouse will mean that the higher income spouse could be able to claim up to $540 off their tax bill. So again, I just look at it like a return on your money. It's basically, okay, well, if you put $3,000 in and you can get up to $540 back, well, that's an 18% return on that $3,000 that you put into super. Again, remember, any money you put into super is preserved. You can't access it until you meet one of those conditions of release. The other major type of contribution, which has come in over the last couple of years as well, is something called a downsizer contribution. Now, the government have also recently changed or proposed to change the rules on this one as well. But the current rules are that if you're over 65, you've lived in your own home for more than 10 years, or it could actually be a previous investment property that you've moved into, or vice versa. So as long as the property's been owned more than 10 years and it's got what we call some capital gains tax exemption on the property, then if you sell that asset and within 90 days of the sale, you can put up to $300,000 into superannuation as a downsizer contribution. Now, the great thing about that downsizer contribution is it doesn't count towards any other caps. So the concessional cap, the non-concessional cap that we've talked about, this is a totally separate cap to those two other caps. So I've had clients where they've already put in $330,000 from the sale of an investment property. But if they want to get more than that in, and they can use the downsizer rule, then they could actually put up to another $300,000 in under the downsizer rule. So again, it's quite a good rule to get money into super. It's not for everybody, but again, you've got to think, okay, we could potentially use that if you're wanting to top up your super. There is another example, Paul, of a client that actually used that downsizer rule. They didn't actually downsize. So what had happened is they basically just moved home. They'd been in their home 30 years. They just wanted to move home, but the new home costs the same as the old home. But they had $300,000 in the bank. Now, because they were over 65 and not working, they couldn't put that money into super. But because they sold their own home, they could use that money to purchase a new home, and then the $300,000 from the sale of their home, they could put into super. So you don't technically have to downsize to be able to use this rule either. So again, it's just thinking about the rules and how we can use those. So again, another key trigger point to probably have a chat or think about what are we doing is if we move home. and we're downsizing.
Lovely. Thanks, Tom. I suppose the one thing that I've got a question here that I wouldn't mind asking before we start going into more of the income stream side of things.
Yep.
Husband and wife are both members of our fund. If possible, or can we, if possible, join the funds together? And if doing this, would that provide a better return than the aggregate of the two individual funds? So I'll let you answer that one, Tom.
Yeah, good question. I mean, I get that quite a bit actually. So the first thing is superannuation has to be in an individual's name, and that's all because of the way super is set up as a trust. So technically nobody owns their super. The trust owns the super. We're all beneficiaries of the super fund. So that's why you can't amalgamate it into one person's name per se, just join the two accounts together. Even in a self-managed fund where people run their own super, they still have to have, okay, how much is for this beneficiary, how much is for this beneficiary. So that's the first thing. As to whether it would provide a better return, if you do the maths, no, it doesn't. If you've got $500,000 in one account, $500,000 in another, you get a 10% return. That's $50,000 return on the money. So that's $100,000 in total. If you had $1 million in one account and you got 10% return, it's $100,000. So just the way the maths work is, yeah, you don't have to worry about if you get better returns from amalgamating them.
Lovely. Thanks for that, Tom. Just a reminder that if you do want to ask any questions, there's that Q&A facility or the chat facility. More than welcome to field them through. So I suppose, Tom, we've looked at ways of putting money into superannuation, non-concessional, concessional, spouse contributions, downsizer. What do we do with the funds once we retire? We've gone through a condition of release. What are the options? And I think the one thing that I can say is that the government, under the current rules, I think it's a great thing. We have the flexibility of doing two things. It's a lump sum withdrawal or an income stream. So can you explain, well, obviously we know what the benefits of taking a withdrawal out. Maybe they want to get rid of debt, but what would be the real benefits of starting an income stream as well?
Yep. So yeah, commonly when I see clients and they're retired, they don't obviously have the income from work. They might have a bit of age pension coming in, depending upon how old they are. But often what they want to do is just top that up with a more comfortable income. So what an income stream provides is just a regular income from your super. The great thing is that money is still invested. Okay, you can choose the same investment options that you had within the super fund. But once you're retired or turn 65, whichever comes first, the benefits of an income stream is that the interest that you earn is tax-free. So that's the real kicker, that any interest that you earn on that account-based pension, which is one of the most common income streams that you can get, is all tax-free. If you leave it in super and you want to just take a lump sum now and again, which you can do, but you've got to remember any super account, even if you're over 65, the interest that you earn is taxed at 15%. So that's the major difference between the super account and what we call a account-based pension retirement account, is that regular interest that you earn on the money is tax-free. So this is why whenever you look at the website, you see the returns for the super, you see the returns for the pension, you look at the balanced option, for example, oh, well, why the returns for the pension more in the, even though it's the same option, is purely a tax difference. Okay, so that's the real benefit. So Paul's got a slide here, moving from super to accumulation. So just think of it as two phases. We've got your super account where effectively that's where contributions go in. You build that up over time. And then once you want to receive a regular income from your super, and you can choose how often you want to receive it, weekly, monthly, fortnightly, once a year, that you can convert it to what we call that pension, account-based pension, where the earnings you earn are tax-free. Just coming back to all super is a tax vehicle, Paul.
Correct. I think that we've pretty well covered over that one to a degree.
Just one thing I'd say on, I guess, that withdrawal, we've got a comment there that, and we haven't really talked about it in too much detail, but again, going back to if you turn 60 and you've met your preservation age, even if you're still working, you can actually start a pension account, it would be called a transition to retirement pension account. Now, those accounts, okay, the interest that you earn are still taxed at 15% on the interest that you earn, like a super account. So the government don't give you that tax benefit for those transition to retirement accounts. And also there is a maximum of what you can draw down from those transition to retirement accounts of 10% a year. Whereas if you're retired or 65 and you've got an allocated pension, there's no maximum. You can take what you want.
Lovely. So I suppose when you look at a pension product, we offer two facilities or two different products. Would you mind explaining how they differ?
Yeah, definitely. So with Australian Catholic Super, we've got two what we call allocated pensions. And that's one's called the RetireChoice allocated pension and one's called the RetireSmart allocated pension. So we'll talk about RetireChoice first. And as it says in the name, what this actually means is that you choose where your money is invested. So I think on the next slide, Paul, we've got 13 different investment options that you can choose from. So you can choose all 13 if you really want. I wouldn't suggest it, but you can basically mix and match. Okay, what level of risk do we want to be taking with our super or the account-based pension? So obviously, if you want to take very, very high risk, you put it all in shares, and very, very low risk is all in cash and term deposits. But often people choose a mixture of something in between, and depending upon what level of risk you really want to take and how comfortable, you can actually choose that. So that's the RetireChoice account. With the RetireSmart account, now this is actually an award-winning product, and there are going to be some changes to this product, I think, probably in the future. But at the moment, the way that the RetireSmart product works is that the super fund chooses the investment options for you. So what the super fund does is they use what we call a two-bucket investment model. They put a portion of your allocated pension in the growth investment option, and then they put a portion of your allocated pension in the cash and term deposit investment option. Now, how much they put in those investments will depend upon, well, how much do you want to take each year from your allocated pension? Okay, so the minimum you have to take is 4%. And depending upon how much you want to take, you can take, I think, up to 10% with this product, that you can choose, okay, how much do you want to take? And what the super fund will do is they will put 2 years worth of your investments into the cash investment option. So just for example, if you wanted 5% of your super every year, they're initially going to put 10% into the cash investment option, and then 90% will go into that growth investment option. Then what happens over time is your regular pension payments, they get paid from that cash investment option. And what happens as well is any interest or cash distributions from the growth assets, they top up that cash investment option to replenish your pension payments. Now, the caveat with this product at present is that you can see there that if you've got 10% in cash, 90% in growth, that you've got to be comfortable that you've got quite a bit of your assets in growth assets. So that means then that if there is a big market downturn, that pot of money in the growth assets can go up and down, can be quite volatile. So not everybody wants to see that happen with their super balance. Okay, so if you're a more conservative type of person or cautious investor, you don't like to see your super go up and down a lot, especially in retirement, this product might not be for you at present. But there are some developments that are going to come with regards to having a bit more control over those growth assets. So all I would say is if you're thinking about these two products, definitely come and have a chat to get a bit more information.
Thanks, Tom. Before we go on and we go into the age pension criteria, there's just a couple of questions I wouldn't mind covering off as well.
Yeah.
So if my husband deposits $3,000 into my account, this is from Mari, it will just be a direct deposit, or does it have to be done via his employer? So I would think that that's in regards to the spouse contributions.
Yes, so effectively you can just put a lump sum deposit from your bank account into super. Doesn't have to go via the employer. But if you have done after-tax contributions via the employer into your super and you want to convert them to a spouse contribution, you can actually complete paperwork to convert them. Generally, though, people just put a lump sum of $3,000 into their spouse's super account.
Lovely. The other one here is that we've explained non-concessional or the tax-free component of your super in relation to your beneficiaries. Can you explain the concessional component in relation to the beneficiaries upon the death?
Yeah, very good question, Elizabeth. Yes, so we'll talk about this in a little bit of detail later on, but effectively any concessional contributions plus interest earned in the super phase, they go into what we call a taxable component. Now, as we've talked about, once everybody turns 60, they can access their super tax-free. But that taxable component, if it got paid to a non-dependent for tax purposes, so spouses, it would still go tax-free. But if it goes to adult children who are non-dependents for tax purposes, they get taxed up to 17%, or well, it's actually a flat tax of 17% on that taxable component. Okay, so the super fund often deducts this from the payment to the beneficiary, or if it goes via the estate has to deduct the tax. Now, there are strategies to actually minimize that tax, and this is why, again, it's important to plan from 60 onwards, because if it's something that you want to look at to minimize that tax for your children, then definitely we can look at how do we minimize that tax.
Lovely. So I've got another question here, is that I hope to work until I'm 70 years, and if my wife retires early, I'm missing key words in the question here, Tom.
You need another coffee, Paul.
I need it. It's past morning tea time. If my wife retires early, say at 65 years, can I still contribute after-tax dollars to my wife's super fund up to the maximum allowed and claim the tax deduction?
Okay, another question that I often get. So you can still make contributions to your wife's super, but you can't claim a tax deduction in your tax return if it goes into your wife's super. So unfortunately, you can't use her concessional cap to be able to reduce your taxable income. The only thing that you can do is that spouse contribution. So if somebody's 65, you can obviously put that $3,000 in because they don't have to meet the work test. And if their taxable income is less than 40,000, then you'll get $540 off your tax bill as the spouse if you're working. So that would be the only tax benefit that you could get, unfortunately.
Okay, so there was a question there about we went through the RetireChoice and RetireSmart. If you start off with one retirement option, can you change that over time?
Oh, definitely. Just like your super. So nothing is set in stone with the RetireChoice account. That if you start off in a conservative fund that you want to make it more aggressive, you can choose that, and vice versa. So very, very flexible, and there's no fees involved in doing that either.
Lovely, thank you. Going back to the contribution about the wife still working, there was a further comment made, but can she get a tax deduction? That would depend if she's actually got any income to claim on the tax.
Well, exactly, Paul. Yes, I mean, if they want to claim a tax deduction, definitely. But if you don't have taxable income to reduce, then there's no point in claiming a tax deduction if you're not paying any tax anyway. So just to be dependent upon what your wife's taxable income is going to be. I mean, it might be that they've got a lot of investment income. They might not be working, but they've got rental income and things like that where they have to put it in a tax return. So yes, you can claim that tax deduction now up until the age of 67 without having to meet a work test if you've got a lot of investment income.
Lovely, thanks, Tom. We might now look in the old, one of the hotly interesting subjects of age pension. Can I tell you the amount of people that have sharpened their pencils to see what entitlement that they'll get? If you wouldn't mind if we could go through the eligibility criteria for the age pension.
Yes, certainly. Well, the first one is age. How old do you have to be to get the age pension? And not everybody I speak to realizes that it's not 65 anymore, that it's actually increasing to the age of 67. So my mother-in-law, again, second time I mentioned her, only 2 times, Paul. She didn't realise that her pension age was 66. So she got to 65 and said, oh, I'll go on the age pension now because I can apply. And I said, oh, actually, no, 66 is your age pension age. So just be aware of that. And it's going up to 67 for people born after, I can't remember now, I think it's 1960 from memory. It's actually on the next slide, isn't it, Paul? I get confused. 1957, there you go, got it wrong. So anybody born after the 1st of January 1957, that's when, well, your earliest you can apply for the age pension is 67. Doesn't mean you can't retire before then. You can retire when you want. You can retire at 60, but it's just that you won't get any age pension until your age pension age. So you've got to be fully self-funded. So that's the key. The other 2 tests, though, if we go back to the previous slide, sorry, Paul, is the main ones. Obviously, they have residency requirements, so resident of Australia. If you have been a resident of another country, okay, for a period of time. So if you can't tell, I do have a bit of an English accent, maybe. They're going to ask me if I applied for the age pension, okay, what are you entitled to in the UK? Because the UK has a different state system, state pension, that if you've worked over there for a period of time and you might be eligible for something, then Centrelink here will want to know, okay, what are you getting from that government potentially? New Zealand is another one, that if you've worked in New Zealand and you're entitled to a New Zealand state pension, because they're not means tested, they just basically is based on how long you've worked there, they give you X amount. Centrelink here will want to know, so just be aware of that. But the 2 tests that they look at, assets and income, okay, and then what they do is they apply those 2 tests separately. They go, okay, under the assets test, this is what you're eligible for. Under the income test, this is what you're eligible for in terms of a payment. And then they're so generous, they give you the lower of the 2 amounts of what you're eligible for. So we'll go through, Paul. I think we've got some slides. Here we go. Okay, the assets test first. So this is for a single person. They go, okay, let's have a look at how much assets you've got. Now, hopefully everybody knows that the main asset that they don't count at the moment is your home. So anything that your home, you can live in a $3 million home, they won't count that as an asset towards this test. Pretty much everything else they will count, okay, as a single person. So superannuation, money in the bank, shares, investment properties, even your car and your contents. They add it all up and they go, okay, if it's above $268,000 in total, sorry, if it's under $268,000 in total as a single homeowner, then you're going to get the full age pension. If it's between 268 and 585 roughly, then what they're going to pay you is a reduced amount going up to that $585,000 on a sliding scale. And then as soon as you've got assets of more than $585,000, well, then there's no pension entitlement, okay? As a non-home owner, they do give you a bit of a larger threshold because obviously you have rent that you have to pay and you don't have that asset as a home. So that's as a single person. And then as a couple, what they do is a little bit more in terms of combined assets. So as a couple homeowner, it's about $400,000. Under that, you're going to get the full age pension as a couple. And then up to $880,000 now. If you've got assets as a couple, then you'll get a part age pension. And then above 880, there's no age pension. Now, the difference with a couple is Centrelink will always look at you as a couple. So they always look at what are your assets as a couple. So even if one of you's over age pension age and one of you's under age pension age, they still look at assets apart from the person under age pension age, how much they have in superannuation. So any money in a super account for somebody under age pension age doesn't count as an asset for Centrelink. So this is where if you're a member of a couple and there's an age gap between you, planning for, okay, what are we doing, can be really important on, okay, well, what age pension might we be entitled to when the older spouse becomes age pension age. So just for example, had a couple the other day where they've got quite a bit of super between them, $1 million. But he was 3 years older than his wife, and he just turned pension age. He had the majority of super in his name, and she had a less super. But if we moved money between the super accounts, and the way that you can move money between super accounts is all around those non-concessional limits, okay, that suddenly his super balance dropped to under 400,000, even though she had over $500,000 in her super, because that didn't count as an asset. Well, he suddenly became eligible for pretty much a full age pension. Yes, when she turns pension age, her super will start counting as an asset and count towards these tests. But for that period of time where she's under pension age, they can maximize their Centrelink entitlements. So again, it's just how do we plan for that is always key. So again, pension age is another key age for when you need to be looking at these sorts of issues. So that's the assets test. So look, once you're retired, 90% of people will be probably on that assets test. Most people will be on that assets test, okay? But they do also do an income test. So for most people, what the income test is while they're still working or their spouse is still working, okay? So they take into account what income is coming into the household. So under a single person's income test, you can actually earn up to nearly just over $2,000 a fortnight. And this is your gross income from work as well, before the age pension cuts off under the income test. So again, I've had clients that were working part-time, and they just thought purely because they were working, they weren't entitled to the age pension. And that's not the case. They just look at, well, how much are you earning? So you can see there that you can have income per annum for a single person of up to $54,000 a year and $82,000 a year as a couple. If your income is below that, then you can get a part-age pension still. So it can be quite important, not just to think, okay, I'm working, I'm not entitled to it. Have a look at your situation. The other thing with regards to employment income as well is the first $300 you earn per fortnight actually doesn't count towards this test. So you can earn $300 a fortnight and it won't actually count towards this income test from employment income, okay? The other income that does get counted towards this test is deemed income from financial investments. So if you've got money in super, they look at, okay, we'll assume you're getting 2.5% income from that investment and add that onto your income test. So again, it gets complicated with the income test, but effectively, whatever you're worse off under in terms of the payments, that's what they're going to pay you. And then the maximum that they're going to pay you for a single person, as we talked about earlier, $24,000, nearly $25,000 a year as a single person, and about $37,000 a year as a couple. Just remember that if you're a member of a couple and one is applying for the age pension, one's under, well, that person applying, they don't get the single rate, they get half of the couple rate, 18,670 is a maximum that they would get. And then if you are separated due to ill health, that's generally if one of you may have to go into aged care, that you actually get the single rate each. They give you a bit more if you're separated due to ill health. If you aren't eligible for the age pension, then there is something called the Commonwealth Seniors Health Card. So I often get the question, look, Tom, I just want $1 worth of age pension because then I get the benefits, so they get the health benefits of the card. Well, even if you're not eligible for the age pension, pretty much 97% of people will be eligible for the Commonwealth Seniors Health Card once they're retired and they're not earning income from employment. And that's purely because this card isn't asset tested, it's only income tested, okay? Now, with the income test, as we've mentioned, they do the deeming on the financial investments. And then if your deemed income is more than $80,000 as a couple, about $55,000 as a single person, that's when you don't get this card. But if you think about, if you do the sums, you've got to have nearly $3 million as a couple or $1.5 million as a single person before you're not eligible for this card. So definitely if you're over the assets for the age pension, it's likely that you'll get this Commonwealth Seniors Healthcare Card, which gives you these benefits in terms of cheaper medicine, bulk bill doctor visits, which is what a lot of people want in retirement. They may also give you a few other discounts depending on your state. What they don't give you is the free car rego, the gas electric bills generally. So that's what the age pension card gives you, whereas this will definitely give you all those health benefits. Okay. Moving quickly, estate planning. So this is really important, and it's getting more important. And I guess that question that we had earlier about tax on super going to the children has made it more important. So whenever anybody comes and sees me, look, we're not solicitors, we're not lawyers, but we always say everybody needs a will. Everybody needs a power of attorney. And it's very important that you nominate who your super goes to. And generally speaking, you do that in the form of a binding nomination. Okay, what a binding nomination means is, well, that's who the money is going to be paid to, no questions asked. Because not a lot of people forget that super doesn't form part of your estate automatically. You have to tell the super fund, okay, where are you paying the money to? If you don't tell them, ultimately the super actually makes the decision on where that money goes to. It might get paid to your estate, it might get paid to the spouse, might get paid to the kids, but unless it's a binding nomination, the super fund goes through basically a process of asking people, okay, who wants to make a claim on this super? And there are strategies as well with regards to estate planning of, okay, how do we minimize that tax that we talked about earlier if money is passing to the adult children, that you want to make sure that that tax is minimized. So that's actually becoming really more and more important for a lot of people as their super balances grow, and they might have more super to pass on in the future. So how can a planner assist? Well, basically, we look at your holistic situation. Commonly, we help in two ways, both tangible in terms of financial benefits, but also intangible in terms of, I guess, more knowledge and security about planning for your retirement. So the tangible benefits that we look at, well, how do we maximize your Centrelink? We can make sure that you maximize your Centrelink, making sure that we save on tax and make sure that we've got as much money for retirement as possible. Okay, estate planning, how do we minimize the tax for the children? So those are all tangible benefits that we can provide in terms of common planning when we see clients. The intangible things are more around, okay, we know that we're in the right level of risk for our attitude towards investing. We can sleep at night. We know that our money is going to last. We can have comfort that, well, we can afford to do what we want to do and not worry about running out of money. That's more the kind of intangible benefits that we get from the value of advice. So we really focus on both of those. It's not just coming to see a planner and thinking, okay, he's going to make me all this money. If I could do that, I'd be doing it for myself and I'd be on the beach. But planning is often all around as well, making sure we've got a plan in place and we know we've got a plan in place to feel comfortable about going into retirement and have less stress going into retirement financially. So with, okay.
Sorry, I was just about to say, I also, I always tell to people that the document that you provide is quite an extensive living strategic document. Now, if you wanted to, you could have that packed under your pillow every night to make sure that you have a bit of a read of some sections. But it's really,
I'm sure some sections would put you to sleep, but yeah.
But I'm sure having it and knowing that you've got your funds all organised and that they will last for your retirement, then I think that that's a very much the biggest intangible benefit that you can actually get. I suppose the one thing, would you mind running through our different advice offerings that we provide at Australian Catholic Super?
Yeah,
the one thing that I would mention that my colleague Justin in Sydney, and I'm hoping that by mentioning his name that wakes him up. No, he's already done it. He is actually going to be placing a link into the chat facility. that if you do want further information from the fund, then you can complete that form and the appropriate person will give you a call. But Tom, would you mind running from left to right and explain the differences between all these product services, or all these different services?
Yeah, certainly. So basically we offer 3 levels. So the first level is what we call general advice. So someone like Paul, Justin in Sydney, they can offer general advice and basically help if you know what you want to do. What they can't do is tell you what to do. So they can't say, well, this is what you should be doing. But definitely we have that service available both over the phone and through the regional managers. That if you want more tailored personal advice, then we've got 2 levels. The first one is what we call over the phone advice about your super. Now, the thing with this is they only deal with your superannuation. And probably the 2 biggest areas that people use, especially going into retirement, is all around investments and how do we build our super in terms of salary sacrifice. So if you want some tailored personal advice on just those 2 topics, then definitely speaking to our over the phone team can be very beneficial. And they will give you a recommendation on, okay, well, this is the sort of investment that we think would suit yourself going into retirement for your attitudes, and also help you with, well, if you're wanting to build up your super, you've got some surplus cash flow or money in the bank, how do we make sure we do that in the most tax effective way, and provide you some recommendations around that as well. The third level is what we call comprehensive advice, and this is where we, sorry, I should have mentioned that over the phone advice, there's no cost for that. The third level is comprehensive advice, which is where I come in, where I sit down with clients face to face or via Zoom quite commonly now, that we have a look at your whole situation. If you're a member of a couple as well, we look at you both. You don't have to be a member of Australian Catholic Super to get holistic advice. And we're here to look at that and go, okay, let's plan holistically how we're meeting all your goals and objectives in the best way. And this is where we can look at everything in terms of Centrelink, Partners Super, estate planning, all these issues that we've talked about, okay? With the comprehensive service, if you've not gone through the service before, the way that it works is that we always have an initial consultation at no cost. We sit down for about an hour. It's very important that in the initial meeting, though, we never give personal advice verbally. What we're there for is to identify, can we help? Okay, if we can't help, then we'd say so and say, look, there's nothing really we can do. But often there is lots of things that we can do that you might not be aware of. And that's where, if you want to employ our services, the way that we charge is always on a fee for service model. So the way that it works is I'd give a quote, a bit like a plumber's quote, to say, okay, putting a plan together, to put the plan together, go through the plan and implement the plan. This is how much it would cost. And it's a bit like seeing your solicitor or accountant. You're just paying for my time and my professional opinion. There's no ongoing fees. I don't get any bonuses or commissions for advice that I do. I get paid a salary every fortnight. So whether people want advice from me or not, I get paid every fortnight, no more, no less. But if we do have to do additional work on top of that original meeting, legally, we always have to charge it back to those clients, okay? Because we can't have it deducted from the administration fee for the super fund, because those clients are getting the advice, okay? Generally speaking, for an initial plan, it could be anything between $2,000 to $2,500 as a general comprehensive plan for a couple. But we would give you a quote and then you can make a decision depending upon the complexity of your situation. And then you would have that blueprint, statement of advice to go through and go, okay, well, and we help you with that. We don't just give you it and they go, there you go. We actually help you implement the recommendations, which generally go over 18, 24 months in terms of advice.
Lovely. Thanks, Tom, for that. So if you do want to get a question answered by either the general advice, I would click on that link. And if you do want to have advice either through the over the phone or the comprehensive advice, can you click on that link and someone will give you a call to arrange an appointment time. Just before we go, I just wouldn't mind finalising off a couple of questions there, Tom.
Yep.
The comprehensive advice fee, is that tax deductible?
And another question I get pretty much every time. Unfortunately, an initial consultation, initial plan is never tax deductible under the tax law. Any ongoing advice or review advice could potentially be tax deductible. It just depends upon what it's relating to. So all I would say is you basically have to speak to the accountant with regards to claiming any tax deductibility on ongoing advice.
Cheers, Tom. Thank you. Just to go back in regards to RetireChoice and RetireSmart, Sam and Tina have asked, just to clarify, can you, with RetireChoice, can you change to RetireSmart and then vice versa?
Okay, good question. Yes, so you're not locked in. So if you choose the RetireChoice product and you want to change the product to RetireSmart or vice versa, you can roll over between accounts. So yes, you can change and chop, but really I guess you want to be setting up something for the long term. So advice that we do, I don't give advice to say, okay, well, do this now and then next year do this, because if I knew that, it would be easy. So we always look at what are your long-term goals as well as short-term, but really how do we set it up for the long term and make the right decision to start with.
Thanks, Tom. We've got a question here from Julia. It's in regards to concessional contributions. And it's good to start with this question, but she's currently salary sacrifices. And she's learnt today that I have approximately $30,000 I can contribute from the last 3 years. So she's talking about the bring forward provision. Do I just increase my salary sacrifice, or can I put in a lump sum via my account?
Very good question. So first caveat, Julia, just to be aware of, is as long as your total super balance across all super funds is less than $500,000 on the 1st of July 2021, then you can use this rule. Okay. And secondly, you can do either. So you can increase your regular salary sacrifice contributions. You can put in a lump sum via the account and claim a tax deduction, as long as you stay within that your personal concessional limit. Okay, and you don't have to do it all for this year. I mean, you can spread that over because it will still carry forward into next year as well, any unused cap. So just think about what your taxable income is going to be both this year, next year, and carrying forward. And again, if you need help with making any decisions, how it's going to impact regular take-home pay if you do it as a regular salary sacrifice, definitely have a chat with our free limited advice service, who will help you out with, okay, how can we do this?
Lovely. Thanks, Tom. I suppose in wrapping up the session today, I would like to remind people that we regularly do run webinars. I think on the 9th of August, but I would just check on our website if you wouldn't mind. But then you can register for our quarterly investment webinar. Our Chief Investment Officer, Michael Block, conducts those. And Michael, I would say, has a wonderful way of presenting in a very layman's terms of what is going on in regards to the fund's investments, our returns and the like. So it's certainly quite a good, I must admit, sometimes the sessions run for 45 odd minutes of a night, but certainly I find them quite valuable, and it's a great source of information. And it's very rare for a superannuation fund to allow members to have access to their Chief Investment Officer, and to even ask questions of him. So, but Michael is very prepared to run the time and do these. I think they're valuable sessions. So I would encourage you to register for those if you wish to attend. We will be conducting throughout the year Centrelink, aged care webinars and the like, but just keep an eye. You will receive some marketing material or an email, but otherwise just to, every now and then have a click back to the website just to check on seminars. The one thing that I would say is that the portal, we've been developing this now over a couple of years, and I think it's quite a good, it's a good website to give you an update on your account. I probably would suggest, though, the only caveat is that you probably shouldn't look too often. Account balances do change over time, and I would suggest that, yes, you can log into the portal, you can register for that all online. You can do a number of things. You can actually update your personal details with the fund. You can change your investment options, which a lot of people are doing. Probably best to get some advice before doing that. And I wouldn't like to think that we're changing them too often. But certainly there is that capability with our portal for you to be able to go in and have a look at your account and do a bit of a self-service capability. So that is certainly available for you. Today, I would like to thank you for your attendance at this session. Thank you, Tom, for your information.
Thank you, Paul.
I've certainly had a message from one of our colleagues that we don't mind talking, and probably we should not be paired together for the amount of talking that we do. But anyway, certainly the contact details of the fund are there. For those people that asked a question, I will be arranging for your local regional manager to give you a call back to assist you with any further questions. I suppose before we go, we just do actually have two late questions. It's with the portal, it says concessional contributions for the current financial year, but how do you find the concessional contributions for the previous financial year? I would suggest you go to the MyGov website for that one. Would that be correct, Tom?
That would be the best source of information, because you can find it on the portal, but you have to do a transaction listing, and then it can get a bit messy. And it will be on your annual statement as well, but definitely MyGov would be a good way to go, because it will just have the total for each financial year.
Lovely, thanks, Tom. And the last question there, Mari, I would suggest that someone will be giving you a call in and going through that process of transferring money between yourself and your husband. It potentially could be possible. Depends on your ages and a number of things and the eligibility to contribute. I would tend to think that that would be best to be answered personally over a phone. So I will arrange for a local representative to give you a call and to go through that question. Again, thank you very much for all attending. For those of you who are in lockdown, I will admit I'm a Brisbane City resident, and I've just been informed that we're in lockdown through till Saturday night now. Tom is a Sunshine Coast resident, and he's free as a bird. You're free as a bird from 6 p.m. tonight, so use your day wisely. That's all I can say. It's a day more than others. Otherwise, you've got the phone contact details of the fund. More than happy to field any questions. All the best if you are currently on school holidays, all the best for the holidays, and all the best for the rest of the year. Thanks for attending. Bye.